Thanks for tuning into the Portfolio Manager. And it's an absolute delight to welcome Rajeev Thakkar, CIO and Director, PPFAS AMC, to join in and talk about the PPFAS Flexi Cap Fund. It's arguably one of the most invested in fund with an AUM of over 60,000 crores. So it's a very large fund, and it's a delight to be talking to him today. Rajeev, great having you. Thanks for taking the time out. Rajeev, how do you look at the portfolio construct at a time like this when almost every second sector, maybe the markets at large, seem to be either expensive or certainly not value currently?
Slowing down a bit, Neeraj. So it's not a time to be very, very aggressive. Now, looking at trailing returns, like we would be somewhere around 39% kind of returns for the year. But still, as compared to the category or benchmark, we would be slightly lower by a few basis points. So it's just that this is not a market where I want to swing for the fences. This is not a market where I want to go very aggressive. Wherever we are seeing things getting a bit uncomfortable, we have been selling those kind of names on valuation grounds. We've been holding some amount of cash. Positioning is a bit defensive. So it's not a very aggressive stance. And you are right, market is either a bit expensive or definitely are not finding very, very attractive opportunities.
So Rajeev, I mean, for somebody who's got the size that you have, the liquidity also becomes a very important part as opposed versus just the prospects of business, right? In any underlying bet that you take. What is the portfolio stance currently? I mean, is it sectorally tilted towards any particular theme more than what the weightages might be? Do you pay regard to those kind of weightages also, or are you not quite paying regard to weightages?
So Neeraj, liquidity is not really a challenge. Valuation is. So we get picked on because we run a single strategy across two schemes in the equity space. So we have a flexi cap fund and a tax saver fund, which largely mirrors the flexi cap fund. Now, in terms of active AUM, we would be maybe 1/6 or 1/7 the size of the larger fund houses that are there. In some cases, maybe, I don't know, maybe even if you add passives, then we may be even smaller. So liquidity is not so much of a challenge. Again, our strategy is not a high churn. It's not that every day I need to turn over the full portfolio by selling something and buying something else. It's largely been a buy and hold kind of fund, even from the time when we were smaller. Sectorally, I think the attractive space is the financials right now, where the valuations are cheap, where the asset quality is quite good. And the only thing that people are concerned about is the growth rates, where RBI has been trying to slow things down in terms of the keeping the liquidity a bit tight, reining in the credit growth. Again, there have been leadership transitions in a few banks. There has been a merger which one of the banks went through. So because of these specific reasons, temporarily the space is out of favor. But I think that space is looking to be of great value. But otherwise, as such, we look at each stock on its own merit. So while we overall don't like the consumption FMCG space given the valuations, but we have a one-off company over there which looked attractive when we added meaningfully to it, and we continue to hold that. So the construct is on a stock-by-stock basis. In terms of sectors, I think the financials and select utilities are looking good. IT services, again, there is some concern about near-term growth because of which they were subdued a while back. Pharma, some names reasonable. So yeah, that's the sectoral view.
Clearly, I mean, when I just scan through what you've done in the recent past as well, right? April versus May, you bought in or you added on to some of these large banking names, pure play banks, private sector banks. So the question that emanates is, do you like private sector banks versus PSU banks? Do you like the large private banks versus the mid-sized banks? And do you like the large private sector banks versus NBFCs? So I've kind of given the three subsets on the banking side per se. Give us some sense of the construct.
Sure. So in the banking space, across private and PSUs, there are, to my mind, five banks, four in private and one in public sector, which have a good amount of scale, which have a good technology platform, which have a range of all the services that are there, not only in banking, but other allied spaces as well, things like life, general insurance, asset management, securities brokerage, investment banking, and so on. So largely it's between these five banks. We prefer the public sector, we prefer the private sector space, but even public sector is not bad and it's reasonably good. As far as the NBFC space goes, we have had a preference towards the banking space instead of NBFC, purely on account of the fact that the cost of fund advantage, I think, is significant for the banking space. Even in terms of term deposits, a private sector bank or a public sector bank will get term deposits at much lower rates than what an NBFC would typically incur. And with increased technology and computerization, there is scope for a reduction in cost to income ratio over a period of time for banks as well. Whereas access to float funds is definitely a challenge for the NBFC players. Also, what happens is typically NBFCs tend to play in one particular segment. So you'll have microfinance players, or you'll have gold loan players, or you'll have commercial vehicle financiers. Whereas in the bank, you get a diversified opportunity in terms of the financial sector. So yes, our preference is towards banks.
Got it. Well noted. And could banks? I mean, this morning we were talking to a sell side expert especially after the banking Q1 updates, the way they have come, Rajeev. And the belief is that if banks miss their earnings in the quarter or for the year at large, it's very difficult for the rest of the sectors to take up that mantle, because it's not that the earnings are looking rosy across. I would just like your broad brush view on banking earnings and whether you believe that they will pick up, and if not, or if, let's assume, if in the event that they were to slip, can some other sectors come to the fore and pick up that tab, or is it going to be difficult for earnings if banks don't live up to their billing?
So Neeraj, different players in the market space operate on different time horizons. There are people who focus meaningfully on what this quarter's earnings will be, and whether the actual reported number will exceed the expectation or will be lower than the expectations, and things like that. Our investment thesis is more medium to longer term, where we are saying that if India has to grow, it cannot grow without the banks becoming bigger. So if real estate sales have to happen, if car sales have to happen, if infrastructure is to get funded, there will have to be lending from the banking space. Near term, yeah, it's challenging, given not because of any thing wrong with the sector. Near term is a challenge because of the global concerns around inflation and the RBI stance of keeping liquidity on a tight leash and slowing down the unsecured lending. Largely, it's been on the NBFC side, but even for banks to slow down that space. So I think it's temporary. As inflation worries go away, as the credit growth normalizes, I think you'll see growth coming back. About the overall market earnings, so we don't track each and every nifty company that is there. So I don't have a market-wide estimate. But from what I'm seeing is that the sales growth are slow. Earlier, there was this margin uptake which happened because of input costs easing. I think that is maybe behind us. So it could be a bit subdued quarter, the way I look at it.
Okay. And so many other sectors to talk about as well, since you mentioned some, but I would love to extend this conversation before we take the first break, Rajeev, to the other aspects of the financial services space. Capital markets, because you had a fair degree of presence there, you probably still do in some fashion, but there has been a fair degree of regulatory action within the capital market space. As recently as last couple of weeks ago, even on the brokerages as well. Now, I would love to understand, how do you think of the various aspects of the non-lending financials, capital markets first, maybe even I'll throw in an insurance out there, because you traditionally used to have, if I'm not wrong, an insurance presence in your portfolio, which is not, which
So
I
we
don't see now.
have had investments in companies which have insurance companies. So we have banks which own insurance companies, and we have a holding company which has a insurance subsidiary. So we do have indirect insurance presence, but no direct investment in the insurance company.
Call. What about capital markets, Rajeev?
Yes. So yes, there have been regulatory measures, but I like to say today, unless you are maybe a seller of luxury handbags, almost every sector is regulated. So if you are in the automobile space, for example, what happens to emission norms? What is the policy around hybrids? What is the policy around electrification will definitely affect you. So whether it be banking, whether it be capital markets, whether it be pharma, everyone is affected by some regulation or the other, and it's a part of life. Capital markets, so the regulations that have come in, I don't think are very, very unusual, because periodically there has been a tweaking of guidelines in terms of reducing risk in the marketplace, or uh, improving competition, or making things better for the consumer. So all these things have been going on for a very, very long time. So shortening of the settlement cycle and so on. This measure, where a certain amount was being charged to the end customer, which was higher than what they were actually paying to the exchanges, I think had to be remedied somewhere, because in a way it's not transparent and it's not fair to the customer. Our concern around capital market has been more around the cyclicality rather than the regulatory changes. So Neeraj, it's interesting to see that, let us say, if the same number of shares traded, let's say company A, every day the volume is 100 shares. Now, when the price of the share is 10, then the traded volume is 1000. And when the price goes to 20, the traded volume goes to 2000. So in a bull market, the volume goes up, the value goes up, everything goes up, and the costs don't go up in line. And so the earnings are very, very strong for all the capital market players, be it the exchanges, be it the stockbrokers, be it the asset management companies. And in a down market, those earnings have a significant dip. So we have had a few years of extremely strong earnings, and again, share prices have gone up significantly. So we have been reducing exposure in this space purely on account of the cyclicality and the valuations, rather than concerns around regulations.
Okay, so the supposed exit from one of the players, or maybe a couple of them, is not because of the regulation thing, but because of the valuation uptick that we've
We have
seen.
been trimming it for a while.
Trimming
So
it for a
even
while.
before the regulation came in, we have been trimming it for a while.
I would love to come and talk a bit about tech, Rajeev. I know you traditionally believe in keeping things simple, But it's difficult to keep things simple with IT simply because there's this whole talk of AI and how would Indian IT work within that whole landscape. Can earnings come back? Is there value right now? Because these are great cash flow generating companies. Multiple arguments, right? And the bulls say that we've seen enough instances of past challenges which they have navigated through. I don't see too many large IT names, except for one or two, within your top 15 holdings. Now, why is that? Are you underweight the sector? If yes, why so?
So, Neeraj, one of the things in the FlexiCap fund that we have is we can invest some money overseas. And abroad, we have companies which are either software service providers, so operating system and office productivity suites, or they are in the cloud computing space or digital advertising and so on. So from that point of view, in the FlexiCap fund, we don't have too many IT services companies, especially the larger ones. In the FlexiCap fund, where we don't have the international exposure, we do have those companies in our portfolio. Coming to the outlook for these stocks, so as you mentioned, there have been multiple cycles in the past. So earlier you had the mainframe-based computing environments, then it moved to the networked and client-server kind of architecture. Later on, there was this big shift towards the internet and multimedia and so on. After that, you had the whole wave of social media, cloud, and analytics, and those kind of things. So periodically, there have been these transitions in the IT services space, and the people have had to relearn the newer technologies. The organizations have had to reinvent themselves, and they are more or less used to it. So you have these periods of strong demand, and then demand off, and then it again comes back. I think this time it will be somewhat similar. The one big concern that people have is around the AI and generative AI, where there is this fear that these large language models can write programs and you won't need so many people to build software. So, of course, some of the things can be automated, and some code can be written. So, debugging can be easier in some cases, or some routine tasks can be automated. But the whole thing about understanding the business case, translating that into the different steps that are required, stitching together all the code, testing it out, all those things will be required. So I'm not so worried about the generative AI thing. There will be some impact, but not as much as generally is feared. Another trend, which is a bit of a dampener, is the setting up of captives here in India. So, what some of the larger players are doing is, rather than outsourcing the activity, they are themselves setting up offshore development centers in places like India, and they are themselves taking people on their payroll. So that uh, trend is something that one needs to watch out.
You, in the past, had liked some smaller IT names, some product companies, etc. There is this whole ER&D space that is now formed out as well. You do not like those pockets as well, or are they just expensive?
So some of the smaller companies that we owned went up like 6, 7x, in some cases 10x in a very short span of time. So valuations became too much of a challenge. So we exited purely based on valuations. Otherwise, the businesses are doing reasonably okay.
Got it. Rajeev, for somebody who told, I mean, we spoke in this interview about how that if India has to grow, if real estate has to sell, then banks have to grow. But you did invoke real estate sales. And for a sector that is in a bit of a frenzy when it comes to pre-sales or quarterly sales, I notice that it's conspicuous by its absence in your portfolio, either real estate or building materials. Why so?
So Neeraj, it's been a difficult sector to invest in. Uh, So if you are buying, let's say, a FMCG company, you buy a soap manufacturer, you know that like clockwork, the factory will keep manufacturing it. They will uh, distribute it via their logistics and supply chain to the stores, and it will get consumed. And you know the margins, you know the ad spend. It's a predictable business. Real estate is very unlike that. One is it works on a project to project basis. So let's say in Mumbai, developer could do well in western suburbs and get stuck in some premium housing in South Mumbai. So you have these kind of things happening. So uh, a lot of people invest at the SPV level, at the project level instead of the listed company. Those people seem to be doing reasonably okay. But otherwise, the money keeps getting redeployed at the company level, and it keeps going through these up and down cycles. Uh, Again, the accounting is tough in this space because percentage of project completion and what are the assumptions and things like that. It's just that time is better spent elsewhere, analyzing and investing. It's too
Got
tough
it.
in that sense.
Fair call. Okay. Okay. Even building materials, Rajeev?
Building materials is an interesting space. So we have looked at it in the past. For some reason, we don't have investments there. And again, things are looking a bit expensive in that space. But that is more or less a predictable business. So
Okay.
anything and everything to do with it.
Got it. Okay. Rajeev,
Tiles, cement, faucets, everything.
noted. Rajeev, my one final question. A lot of people talk about this, right? I mentioned this at the start of the second segment that you look at mutual fund investments over 3-5 years and not over 1 year. And even with this high base, you've done so well. The question that comes in that in the last 1 year, if there has been a percentage point of underperformance, is it attributable to size? Is it attributable to the fact that you don't have as much global companies exposure as you used to? And so many theories float around. I would love for you to talk about it because it's best to hear it from the horse's mouth.
So you are being too kind, Neeraj, attributing size to the underperformance. I have underperformed uh, by much bigger margins when I used to run a 100 crore fund. This is way back in 2007. So that time, if memory serves me right, the portfolio was up around 35% and index was up some 70%. So you are doing half of what the index was doing. Yeah, as I said, more than liquidity, valuation is a challenge. If you want to buy shares, you just have to press a button on the dealing terminal and shares will get bought. That is not the challenge. The challenge is that the prices at which stocks are trading right now generally means that you take that much longer to deploy and for opportunities to come your way. And uh, to give a cricket analogy, if uh, you need maybe 4 runs and over, why would you risk losing a wicket trying to hit a six? Happy to underperform in such markets.
Yeah, and sit on a pot full of cash to wait for the next big opportunity. But great to understand that perspective, Rajeev. Thank you so much. Thank you so much for joining us on the show and giving us the lowdown on how you think about portfolio construct currently. Really appreciate the time.
Pleasure. Thanks.
Well, that's the view from PPFAS. Rajeev Thakkar, CIO and Director of the AMC, talking about the portfolio construct in the current scenario. Hope you found it as useful as I found it while doing the show.